Most careers don't end with a single mistake. They end quietly, long before the final loss, long before the account statement forces honesty. What actually destroys a trading career is a sequence, a progression that feels reasonable while it's happening, logical even, until it isn't. Most people don't notice this until it's too late. They remember the last trade, the blow-up day, the sudden collapse. But the damage started much earlier, when nothing looked wrong at all. This matters because if destruction has stages, it also has warnings, and warnings mean there's still time, at least sometimes. This is timeless market lessons, where market wisdom outlives markets. What follows isn't theory. It's an observation earned through loss, repeated loss, the kind that leaves no room for excuses. There's a particular pattern that shows up before almost every professional failure in markets. Different instruments, different decades, different personalities, same sequence. At first, it doesn't look dangerous. It looks like progress. Here's where traders usually get it wrong. They assume discipline breaks down under pressure, but that's not how it happens. Discipline erodes when pressure isn't obvious yet. Stage 1 begins with competence, not brilliance, not recklessness, competence. You find a process that works. Your decisions start to align with outcomes. Losses feel contained. Wins feel deserved. And slowly, something subtle shifts. You stop focusing on the process itself. You start focusing on the results produced by the process. This isn't arrogance yet. It's comfort. The routine becomes familiar. Preparation becomes lighter. Risk checks become quicker. Nothing dramatic changes. That's why it's dangerous. Here's a stat most people ignore. The majority of professional blow-ups occur after a period of consistent profitability, not before. That's not coincidence. Because success doesn't just reinforce good behavior, it also hides small violations. A position held slightly longer than planned. A rule bent but not broken. A loss rationalized because the broader month still looks fine. At the time, it felt logical. It wasn't. This is where identity quietly enters the picture. You stop seeing yourself as someone who follows a process. You start seeing yourself as someone who knows the market. That distinction matters more than it sounds. A trader who follows a process assumes they can be wrong at any time. A trader who knows the market assumes the market will eventually agree. That's stage 1. Competence turning into confidence. Confidence slowly detaching from rules. Pause here for a moment. Ask yourself this. Are your rules written to protect you from losses or to confirm your intelligence? Most people don't like the answer. Stage 2 is harder to spot because it feels like growth. This is where scale enters. You're no longer testing ideas, you're expressing conviction. Position sizes increase, not dramatically, incrementally. The justification sounds reasonable. I've seen this setup before. My win rate supports it. I understand this environment. And maybe you do. That's what makes this stage so deceptive. The problem isn't the size itself, it's what size does to behavior. Larger positions compress time. They shrink patience. They make noise feel like signal. You start checking prices more often, not because you need to, but because you care more. Losses feel heavier. Wins feel relieving instead of satisfying. This is the stage where traders begin managing emotions instead of managing risk. They exit early to avoid discomfort. They hold losers because exiting would confirm doubt. They start adjusting plans mid-trade, not based on information, but on sensation. Here's where silence matters, because if you pause long enough, you'll notice something unsettling. Your process hasn't improved. Your exposure has. That gap is dangerous. This is the stage where Paul Tudor Jones ran into serious trouble early in his career, not because he didn't understand markets, but because his confidence outpaced his constraints. Twice. And that detail matters, because the market didn't teach him once and move on. It let him repeat the mistake. The pattern repeats, always. Stage 2 ends with fragility. Your edge becomes dependent on conditions staying favorable. Your emotional state becomes tied to individual trades. Your tolerance for uncertainty shrinks. And when uncertainty spikes, as it always does, you enter Stage 3. Stage 3 isn't chaos, it's urgency. This is where traders feel the need to do something, reduce the loss, win it back, get flat, get right. Decisions speed up, context disappears, everything becomes short-term. This is where overtrading begins, not because of greed, but because stillness feels unbearable. A bad trade no longer feels like part of a distribution, it feels personal. Risk limits are viewed as obstacles, hesitation feels like weakness, and the most dangerous thought enters the room. I can't afford to be wrong here. That sentence has ended more careers than any market crash. Because the moment you believe you can't afford to be wrong, you will ensure that you are. This is the final identity break. You're no longer acting as a risk manager, you're acting as a defender of self-image. Every decision becomes heavier, every outcome feels loaded. And when the loss finally arrives, the one people remember, it feels sudden. It wasn't. It was earned slowly, quietly, stage by stage. If this feels uncomfortably familiar, that's not an accident. Most people listening are somewhere between Stage 1 and Stage 2. Very few admit it. Almost no one plans for it. If this resonates, subscribe. We explore these patterns weekly. The uncomfortable truth is this: career destruction doesn't come from ignorance, it comes from misaligned confidence, from exposure growing faster than restraint, from identity outpacing process. And the reason this pattern matters isn't fear, it's clarity. Because once you can see the stages, you can interrupt them. Not with motivation, with structure. There is a specific rule, simple, emotional, that reversed this trajectory after everything was lost. Not once, twice. But that rule only makes sense if you fully understand what came before it. The damage from Stage 1 and Stage 2 isn't obvious in real time. That's what makes Stage 3 feel so unfair. You don't feel reckless. You feel cornered. The market hasn't turned against you yet. It has simply stopped cooperating. This is where the inner conflict begins. Because part of you still remembers the discipline, the rules, the restraint that worked before. And another part of you is convinced that backing off now would waste everything you've built. This conflict is quiet. There's no panic at first, just friction. You hesitate longer before entries. You second-guess exits. You replay decisions in your head after the fact, searching for certainty that no longer exists. Most people don't notice this stage until it's over. Here's why. The external behavior doesn't look broken yet. You're still trading, still showing up, still following your system. But internally, the posture has changed. Risk no longer feels like a variable. It feels like a threat. And when risk feels threatening, the brain stops optimizing for long-term survival. It starts optimizing for immediate relief. This is where traders sabotage themselves without realizing it. They cut winners early because unrealized profit feels fragile. They let losers run because exiting feels like admitting failure. They widen stops not to improve expectancy, but to reduce emotional pain. This is where traders usually get it wrong. They think the problem is emotional control. They try to calm themselves, meditate, take breaks. Those things help, but they don't address the real issue. The issue is exposure. Here's a perspective shift. Emotions don't destabilize decision-making on their own. Exposure does. When position size exceeds emotional capacity, the mind adapts in destructive ways. It distorts information. It narrows time horizons. It prioritizes relief over accuracy. This is why stage 2 is so dangerous. It quietly trains you to operate beyond your emotional limits. By the time stage 3 arrives, the system is already compromised. Let's pause here. Think about your worst trading decisions. Not the losses themselves, the decisions. Were they made when you were underexposed or overexposed? The answer is almost always the same. Here's a short story. A trader I knew ran a disciplined book for years. Clear rules, consistent returns, no drama. Then came a stretch of exceptional performance. Nothing outrageous, just steady wins. He increased size gradually, barely noticeable. When the environment shifted, he didn't blow up immediately. He fought the tape. Smaller losses piled up. Confidence eroded. He started adjusting. By the time the real loss hit, the account couldn't absorb it. Not because the trade was catastrophic, because the structure was gone. That's the inner conflict. You're no longer fighting the market. You're fighting the consequences of past confidence. Silence here matters, because this is the moment most traders either learn or repeat the cycle. What changed everything wasn't insight, it was restraint. This is where the realization emerges. The market doesn't punish bad ideas as often as it punishes oversized ones. Read that again. Bad ideas fail all the time without destroying careers. Oversized ideas don't. The realization is simple but uncomfortable. You don't need better predictions. You need positions small enough that being wrong doesn't change your behavior. This is the core mistake most traders make. They size positions based on conviction. Professionals size based on tolerance. That distinction changes everything. When Paul Tudor Jones reflected on losing everything twice early in his career, the lesson wasn't about markets, it was about himself. He realized that no idea, no matter how well researched, deserved the power to damage his psychological stability. That insight led to a single rule. A rule so simple it sounds trivial until you understand its purpose. Never put on a position large enough that it makes you care about being right. That's it. Not never lose, not always be confident. Never let size dictate emotion. Because the moment a position demands emotional management, it has already exceeded its optimal size. This reframes risk entirely. Risk isn't about drawdowns, it's about decision distortion. A position is too large the moment it changes how you think.
That's the realization. It doesn't promise profit. It promises clarity. With smaller size, losses return to being information instead of threats. With smaller size, patience returns. With smaller size, the process becomes visible again. This is why most traders never recover after a major loss. They focus on rebuilding capital. They ignore rebuilding psychological margin. Here's a quiet stat. The traders who survive decades aren't the smartest. They're the least emotionally exposed. If this sounds restrained, it is. That's the point. If the channel is built for listeners like you, consider subscribing. The realization isn't dramatic. It doesn't feel powerful in the moment. It feels limiting. But over time, it does something rare. It restores trust between you and your decisions. And without that, nothing else matters.
The application of that rule doesn't announce itself with confidence. It shows up quietly in the way the day begins, before the screens, before the news, before opinions form. Smaller size forces a different morning. Preparation slows down, not because there's less urgency, but because there's less fear. You review levels without urgency. You map scenarios without attachment. You accept that most days will offer nothing worth doing. That acceptance is difficult at first, because when size shrinks, activity often shrinks with it, and inactivity feels like regression to someone who equates effort with progress. But something subtle changes. Your first trade of the day no longer needs to matter. It just needs to be correct relative to the plan. Execution becomes quieter. Stops are placed where they belong, not where they feel comfortable. Targets are respected because there's no emotional pressure to extract meaning from every move. This is the difference between amateur execution and professional execution. Amateurs trade to feel engaged. Professionals trade to remain aligned. The rule about size does something most people don't expect. It returns optionality. When positions are small, you can wait. When you can wait, you can choose. When you can choose, decisions regain quality. Here's a pause worth taking. Notice how often bad trades begin with the thought, "I should probably do something." That thought disappears when exposure is sane. Daily execution becomes less reactive. Fewer trades, cleaner entries, more flat days. And flat days stop feeling like failures. This is a perspective shift most traders never experience because they never give themselves the emotional space to experience it. There are consequences to ignoring this lesson. They're not immediate, they're cumulative. You begin compensating for size with effort, more screens, more indicators, more opinions. Complexity rises to justify exposure. The system bloats, the clarity fades. Eventually, you find yourself working harder for worse decisions. This isn't burnout, it's misalignment. The market hasn't changed, your relationship to risk has. Here's where learning becomes unavoidable. You start reviewing trades differently, not asking, "Was I right?" but asking, "Did this position allow me to think clearly?" That question changes what gets adjusted. You don't tweak entries as much. You don't chase new strategies. You adjust size first. Losses become data again. Wins lose their emotional charge. The account grows slower, but steadier. This is the kind of growth that doesn't announce itself. It compounds quietly. And something else happens outside the market. Evenings feel lighter. You stop replaying trades during conversations. Sleep improves. That's not incidental. When risk is contained, life re-enters the picture. This is the part most trading education never mentions.
Career longevity isn't just about surviving drawdowns. It's about preserving relationships, health, perspective. When trading stops demanding emotional recovery, it stops consuming identity. You become someone who trades, not someone who is a trader. That distinction protects you during inevitable losing periods, because losses no longer threaten who you are. This is why the rule works, not because it improves outcomes directly, but because it protects behavior. Late in his reflections, Paul Tudor Jones described risk control not as defense, but as freedom. Freedom to think, freedom to wait, freedom to survive long enough for edges to matter. That framing matters, because if you see restraint as weakness, you'll always violate it under pressure. If you see restraint as freedom, you'll protect it. There's no final resolution here. Markets change, edges decay, confidence fluctuates. The stages never disappear entirely. They wait. But once you've seen them, they're harder to ignore. You notice confidence rising faster than discipline. You notice size creeping ahead of clarity. You notice urgency where patience used to be. And when you notice it early, the correction is small. That's the quiet victory. Not avoiding loss, avoiding distortion. Most careers don't end because traders lacked intelligence. They end because exposure erased judgment. The rule doesn't make you right, it keeps you rational. And in markets, rationality is survival. That's the lesson that lingers. Not dramatic, not comforting, just durable.